Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Hello, and welcome to our series on analyzing self-employed income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. In this short tutorial, we'll discuss the foundational concepts of analyzing self-employed income to determine if it meets the eligibility requirements for use in qualifying for mortgage financing. We'll identify who meets the definition of self-employed. What are the eligibility requirements that must be met in order to use this type of income, and what factors need to be considered? So, let's get started. We'll begin with the definition of a self-employed borrower. Who is considered to be self-employed? Fannie Mae and Freddie Mac define a self-employed borrower as any individual who has a 25% or greater ownership interest in a business. How will you know if your borrower has ownership in a business? The Uniform Loan Application, otherwise known as the URLA or the 1003, will give you a clue. In the employment section, there's a self-employed indicator box where the borrower will be asked to check if they are a business owner or self-employed. Additionally, they will be asked if they have an ownership share of 25% or more, and if that is the case, then they are considered by us folks in the mortgage industry to be self-employed. What else is needed in order to use self-employed income? Generally, a 2-year history is required. Exceptions may be considered for borrowers with at least a 12-month history of self-employment. If the borrower has a history of receiving the same or greater income in a similar field or position, or if the borrower has been in an occupation where they have had similar responsibilities as the current business. Remember that the borrower's federal income tax returns must reflect at least a 1-year history of self-employment income, and the lender must take into consideration the overall layering of risk present in the loan file. What else is required to use self-employed income? The business must be financially stable, and the borrower should have a history of receipt of earnings. So the questions to consider are, do the business earnings trends support the likelihood that the cash flow will continue? Will the business generate sufficient income, and is there a history of the business distributing income to the borrower? Some other factors that you need to consider are the location and the nature of the borrower's business, the demand for the product or service offered by the business, the financial strength of the business, the stability of the borrower's income. In the end, we are trying to determine the ability of the business to continue generating and distributing sufficient income to enable the borrower to make the payments on the requested loan. Let's break this down further, starting with the location and nature of the borrower's business. Let's look at a scenario that will illustrate why this is important. Our first scenario involves a business that is on the move. Ben has been operating a successful business selling bicycles in Baltimore, Maryland. He has applied for a loan for a purchase of a new primary residence in Denver, Colorado. He will be using funds from his business account to help pay for the closing costs. What concerns might you have? Since Ben is relocating from Maryland to Colorado, we would be concerned about the business market acceptance in its new location. Additionally, since this business is inventory-driven, we would have concerns about the use of business funds, as the business requires the purchase of new inventory in order to continue to generate revenue. Now you can see how considering the location and the nature of the business are important. First, we need to take into consideration the location of the business, especially if the transaction at hand involves a relocation of the borrower from one area of the country to another. If the borrower is relocating to a different geographical area, then we must consider and evaluate the acceptance of the company's service or products in the new marketplace. Market studies, along with written analysis confirming the borrower's income will continue at the same level in the new location, are required. Secondly, we need to think about the nature of the business, as this gives us a picture of what type of business it is and what is involved in the operation. It will become important to our analysis to understand if the business is dependent on inventory or in a high-cost goods industry that is dependent on business assets in order to continue to generate revenue. Let's take a closer look at how we might uncover the location and the nature of the business. Thinking about the business at hand, Tech in a Sec. By looking at the Schedule C, we know that this business offers computer repair services. We further note that the business is currently located in a commercial setting at 1400 West Commercial Avenue. What are some other ways that we can start getting a picture of our borrower's business? You can search for the company website and read about the company. You can look up the business on the Secretary of State website. Lastly, you can search the IRS business code. Taking a closer look at that last one, as you look at the business tax forms, the business type code will be provided. In this case, we see a code of 811490. Searching for that code, we see that the code corresponds to the following description. This industry comprises establishments primarily engaged in repairing and servicing personal or household type goods without retailing new personal or household type goods. Now that you know the nature of the business, you can consider the demand for the product or service. Thinking about Tech in a Sec, we know that this is a business that offers computer repair services, and you can consider that with what you know about your current environment. Do you believe that there is a demand for this service? What if I told you that Tech in a Sec used to be a typewriter repair company? If the business had not made a transition over the years to providing a more innovative service, then how would you feel about the demand? Next, we need to consider the strength of the business. How do we go about that? A lot of times when folks analyze a business, they focus on the gross receipts or sales. And we do need to look at the overall trend in income. However, there are other things to consider. We also want to analyze the costs of goods, business expenses, and overall net profit. If we only focus on the gross income, then we are not considering rising costs of goods and expenses and what percentage of the gross income is attributed to expenses. We want to ensure that all income that is included is recurring in nature. We need to analyze the overall trend over time. Remember that the source of your borrower's self-employed income is the business, and as such, an analysis of the business must include a determination of whether or not the business has sufficient liquidity and is financially capable of producing stable monthly income for the borrower. When it comes to assessing the overall risk factors in the loan file, your self-employed borrower is seen as riskier since their income tends to fluctuate. This type of income is considered to be variable, and as such, the trend in earnings needs to be analyzed. Let's examine further what type of trends you may see upon review of your borrower's tax returns. As the saying goes, the best predictor of future behavior is past behavior. In order to analyze the stability of income, you need to look at the overall trend in income received in the last 2 years. Is the trend in the amount of income stable or increasing? In which case, taking an average of the income would be appropriate. Has the trend in income declined but has since stabilized? Then the average of the lower income year should be used. Or is the trend declining and the borrower has not been able to provide verification of stability? If that is the case, then no income from the business should be used. Let's take a look at another scenario involving this concept. Our loan officer is in the process of qualifying their self-employed borrower. Upon completion of the business cash flow, they noted that the income was lower in 2022 than in 2021. Knowing that declining income is a concern, they calculated the qualifying income by using an average of 2022, which was the lower of the 2 years. They were relieved when the borrower still qualified. However, did they miss an important step? Yes, they did skip an important step. Since there was declining business income, it would have been crucial to provide verification that the business income has since stabilized by review of the year-to-date profit and loss statement or by review of 3 to 6 months of business bank statements. The history and continuance of income must be analyzed. I always like to think of this as 2/3. When you're asked to review documentation covering a 2-year history, you must consider the trends in earnings for the most recent 2 years. You also must evaluate the likelihood that the income can be expected to continue for 3 more years. If the analysis reflects that the income has significantly increased or decreased, then documentation and justification to support the income is likely to continue is required. It may be necessary to obtain additional year's tax returns or business financial statements if the income is fluctuating in order to determine stability. Does self-employed income always need to be analyzed? The analysis of business income is not always required. However, it is required if the business income is being used to qualify the borrower for the loan and the source of the income is the business. Then the business must be analyzed. This includes ordinary income, rental income earned by a business, guaranteed payments, and W-2 wages. This last one is confusing to many people. Some folks think that if there is a W-2 present in the file, then that income can be considered to be salaried income. But if the employer listed on the W-2 is the borrower's business, then this is still considered to be self-employed income and the source must be analyzed. When does self-employed income not need to be analyzed? If the borrower has a primary source of income other than the self-employment and the self-employed income is not being used for qualification, then no additional documentation or evaluation is required. If, however, the borrower is overall self-employed and they do not have any other source of income, then all the self-employment should be evaluated. At the end of the day, when we find ourselves in left field, deep in the weeds, let's go back to why we are analyzing businesses in the first place. The purpose for this analysis is to substantiate the strength of the business as the source of the income. We want to confirm that the business will continue to generate income. The goal during this analysis is to evaluate the business for stability, profitability, and continuity. As you can now see, taking the time to analyze the business, which is the source of your self-employed borrower's income, is a very important step. Considering the location and the nature of the business, as well as the demand for the services or product, along with the earnings trend over time, are all crucial steps in determining the financial strength of the business and the stability of the income. Determining the likelihood that the business will be able to continue to distribute income to your borrower is paramount to ensuring their ability to make the mortgage payments in the future. Remember, it is our responsibility to set our borrowers up for success.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.